Hello, the name is Osvaldo Antonio Nyaka, and welcome to another one of these weekly enlightenment videos where we just explore around the different areas of life and we share some universal principles that you can take, implement them, and hopefully make a difference in your life. The one thing that I have come across in all my years of studying human behavior is that we are all here to empower these 7 areas of life. There are some philosophers, writers that speak about the areas of life that go beyond 7 areas. But for me, I learned this from my mentor, Dr. John DeMartini, about the 7 areas of life. And for me, it makes sense. And I love breaking it down to the 7 areas. What are these 7 areas that we're here to empower? Well, we're here to empower, first of all, our financial area of life, our family aspect of life, our social, spiritual, mental, vocational, as well as a physical aspect of life. Now, in today's video, we're going to be focusing on the financial aspect of life, as this not only impacts all the other 6 areas, but also plays a vital role in the relationships that we have in society. We are going to be talking about some universal principles or principles that govern money and finance. And hopefully what I'll be sharing with you today, you can take it, implement it, and it will make a difference in your financial aspect of life. Now, when it comes to finance, there are two critical things to understand. There is the debt or loan aspect, and there's the savings or investments aspect of it. How I love to define the debt or the liability side of this is when you either take out a loan or have a liability, what you're doing is you're extracting a future value of money and bringing it to the present. So in other words, think of it as if you go out, get a loan or get into liability, you get a liability or a loan of 10,000, doesn't matter what the currency is, just use whatever currency that your country uses. So in other words, let's just use US dollars for the sake of our example. If you go and take out a loan of $10,000, what you're doing is you're extracting a future value of that $10,000 and bringing it in today and using it today. So what that means is with that $10,000, you then have to pay back not only the principal, but the actual interest that comes along with that $10,000. So what you're doing is you're taking a future value of money and using it now. How you make use of that money, it's got various options. You can use it either to consume, buy consumables, and then you pay interest on that, but what you're doing is you're using it for immediate gratification. Whereas on the opposite side or the other side of it is the investing or the saving. What you're doing with investing or saving is you're taking a current value of money and taking it, building a future value of that current money. So in other words, you're growing, you can say $1,000 into 5 or 10 years, hopefully growing $1,000, earning interest and giving you back an income into $10,000. So what you're doing is you're creating a future value of money. Those are the two differences when it comes to debt, loan, saving, and investments. Now, when it comes to investing your money and growing your money, there are 3 different levels. And this is what I want to go into detail of when it comes to growing your money in these 3 different levels. Now, I have to give a little bit of caution and tell you that I'm not giving you investment advice. We're just talking about the principles that govern investing and growing your money. We're just talking about the 3 different levels. In no ways am I saying go and buy this specific share, go and invest in this specific way. All I'm doing is giving you specific principles that govern investing and growing your money. There are these 3 different levels. The first basic level is income. Income is where you invest your money into a principal preserving instrument. A principal preserving instrument could be something like a savings. Now, a savings is the lowest, the easiest form of investing, and it is the highest guarantee that you're going to get back for your money. And in this, what you're doing is you're investing for an income. So for instance, if you take 10,000 or 1,000 US dollars, you put it into a bank account, and that bank account gives you a guaranteed return. When you invest for an income, the risk levels are very low because you're guaranteed that income and that return. Now, what happens at this level of investment is your returns are lower because you're guaranteed an income and that comes back to you. And normally people have a problem with savings. They normally look at it and be like, oh, savings is boring. I'm not going to get wealthy of savings. What would it ever do to me? And I usually tell people that, listen, unless you've mastered this first level, the other levels won't make sense, because once you put your money into a savings account, what that teaches you, it teaches you how to think long term, as well as it teaches you how to earn back an income of the money that you invest. So for instance, if I go take the $1,000, put it into an investment that pays me, let's just say 10%, I know that I'm guaranteed to get the 100 back, 100 US dollars back on that 10%. So I know that every single month I will be earning interest on my principal. The next month it will be 1,100 US dollars if I just leave it there like that. Then the second level is now when you start investing into things such as the stock market, ETFs, mutual funds, and all of these investment instruments that are above savings. Now, at this level, what you're looking at is you're looking for income and growth. So, for instance, if I invest in the stock market, I go out and I invest into an ETF. What that ETF will give me will pay me in dividends, as well as the share price of that investment could grow. So what you're looking at the second level is both income and growth. Income and growth in terms of dividends paying you, and as well as the share price having the potential of growing. So for instance, if I buy a share at perhaps $2, my hope is that in the future, the $2 is going to go up to $4, $6, $10, and it's going to grow in that worth. But I'm getting paid dividends yearly on that investment. So at the second level, you're looking for income and growth. Now, the third level, and this is where now it's high risk, high returns, as well as you have the highest potential to lose your money. This is where you're investing into instruments that are geared by growth. These instruments include things such as your Forex, your foreign exchange, where you are buying or trading different currency pairs in order to gain the growth of that. These are high risks because you cannot determine what the dollar price is going to be tomorrow versus the rand, for instance. You cannot determine where the foreign exchange is going. They're very, very volatile. But yes, they do pay you back for the risk that you're taking, but you can lose your money within a day or two. So the higher you go in these investment types, the riskier it gets, but of course the rewards is what you get back for taking that risk as a reward. Now, most people are normally introduced to the high gearing stuff where they say, okay, no, put in $100 and by tomorrow it'll turn out to be $25,000. Now, if you haven't mastered the first level, the second level, and the third level, what will happen is if you don't have enough funds in those other levels, the moment you lose that, then your base is gone. And you psychologically, you won't be able to handle the fall. So I always tell people that before you go into these higher risks investments, first start off with your savings. Take your income, multiply that by 3 to 4 months, and then make sure you have that as a base in a savings account. so that you're able to then move to the next level of investments, your ETFs, your blue chips, your mutual funds. Then use the same formula, 3 to 4 months worth, and invest into that, and then go higher up into those higher risk of investments, so that not only are you steadily growing, but you have something to fall back on. And when you have something to fall back on, psychologically, you start to look at your money differently, because now you're not going in to lose your money. You're not going in to take these higher risks, which has a higher potential of you losing your money, but you're steadily growing your wealth, steadily growing your money, so that you're psychologically understanding how businesses work, psychologically understanding the principles that govern money, and you're also growing it by using patience and not overnight success. Just understand that the higher up you go into these risks, just know that the higher the potential it is for you to lose money. So psychologically, what drives us into these financial aspects of life, it all has to do with a hierarchy of values. If, for instance, you don't have savings and investments higher up on your hierarchy of values, what you'll tend to do is the moment you receive money, you will spend according to what you perceive to be most important. If, for instance, that instant gratification seems to be a higher value, the moment you get money, you're going to spend on consumables. And if consumables is more important than saving and investment, then your financial destiny will be determined by that. And not only will you be driven to want to consume more, but you're also going to put yourself down the moment the conversations of savings and investments come up. The one thing that you can do to sort of make saving and investments a priority is to actually find out to you what would be the benefits of saving and investing money. The more of these you get to accumulate, the more important it becomes, and the more that psychological switch becomes, because now you're saying, instead of buying that consumable, that expensive car, that expensive house, how do I take this and have it in the form of savings and investments? Just stack up the benefits of saving and investment. For the training courses that I run, I normally have my students go in and actually write down what are the 200 benefits of saving and investments. So they actually make that psychological switch. And just remember that whatever you don't empower in your life, you will get overpowered by other people. You're not a victim of their empowerment. You're just not empowered in that area of life. Thank you.